In this week's video, we'll review the latest charts to help us answer the question, will an inverted yield curve lead to a recession and bear market? There have been a lot of scary headlines in the past 6 months related to a flattening or inverted yield curve. While the yield curve is a tool that's worthy of being carried in our weight of the evidence arsenal, it's extremely important that we understand how to use it properly, what it tells us, and what it doesn't tell us. The traditional yield curve, you take the yield of a 10-year treasury and you subtract the yield of a 2-year treasury. In the present day, this is the yield curve here. The yield curve is approaching the zero line. When it drops below zero, that's what's known as inversion, and that would tell us that the yield on a 2-year treasury is actually higher than the yield on a 10-year treasury. And the theory related to the present day concern is if people are buying 10-year treasuries, the conviction to own a 10-year treasury is higher than the conviction to own a 2-year treasury. That probably tells us that investors are concerned about future economic growth and aren't overly concerned about the Fed raising rates multiple times over a multiple year period. It's always good to think in maximum terms. In November of 2008, which is maximum fear, people think the economy is never going to come back, the stock market will never come back, and thus the Fed will never raise interest rates again. In fact, they should be lowering them. If that's the case, you want safety of principal, and you want to nail down your yields before the Fed lowers rates. You do that with long maturity treasuries, 10 years, 30 years. Maximum fear. In the ETF world, people gravitate towards TLT. So the first question is, in the present day, the yield curve approaching the zero line, how concerning is that from a historical perspective? Is it possible that good things can happen after something like this? As always, let's answer that question with facts rather than opinions. This is the same yield curve that we just looked at. The level in January of 1995 was 0.34, which is very, very similar to present day levels. This chart was printed on 6/25/2018. The yield curve was at 0.33, which is basically identical to the level in January of 1995. Let's take the same chart and make it a little smaller to make this point. With the yield curve falling into January of 1995, we easily could have said the yield curve is about to invert. In the present day, falling, we can easily say the yield curve is about to invert. So what would have happened on January 31st, 1995, if we jumped the gun and said the yield curve is about to invert, therefore a recession is right around the corner and a bear market will come with it? Would that have been helpful? So if we fast forward with the S&P 500, we can see the answer is it wouldn't have been very helpful at all. In this case, the yield curve did not invert. So point number one is the yield curve is about to invert. That's a form of forecasting. We don't know in the present day if the yield curve is going to invert, just as investors in January of 1995 didn't know that the yield curve was going to invert. The yield curve is about to invert is quite a bit different than the yield curve has inverted. If you jump the gun here, you might have missed a 225% gain in the S&P 500. Let's ask the same question. What would have happened in January of 1995 at the end of January if we said the yield curve is about to invert, it's time to get out? What happened in the NASDAQ after this point here? The answer is, rather than having some type of horrible bear market, January of 1995 was an excellent time to be a long-term investor with a long-term outlook. The NASDAQ moved from point A to point B, the gain 568% from a position where people were saying the yield curve is about to invert. If you're a client or a regular viewer of these videos, you might already be thinking, well, we've already looked at numerous comparisons from a technical and economic perspective that say the 1995-1996 window is very, very similar to the present day. Well, we can add another one. The yield curve looks very, very similar. It's falling. It's falling in the present day. And in this case, it stays above the zero line. We've been talking about 1995 for a long time. Here's a video that makes comparisons to 1995, published on December 16th, 2016. Bear with me here. This looks very, very noisy and confusing, but we're going to walk through it step by step. This is the same yield curve that we've been looking at, 10-year yields minus 2-year yields. And this here is where the S&P 500 peaked on Friday, March 24th of 2000. And you can see on that date, the yield curve was inverted. To make a similar comparison, let's look at 2018, where the S&P 500 peaked. On January 26, 2018, the yield curve was at 0.53. Both of these charts show us 151 days after the peak, and they both cover a 3-year period, so we can compare apples to apples. Relative to helping us forecast or predict this major peak, how was the yield curve helpful and how was it not particularly helpful? Unbelievably, the first sign of yield curve inversion occurred 668 days before the major peak in the S&P 500 index. In 1998, we actually dipped below. This is yield curve inversion. And if you know your market history, you know in 1998, after this inversion, there was a significant correction. However, there's a big, big difference between the correction that took place in 1998 and this major peak here. And from our perspective and our time frame, this is the type of peak that we're concerned about. In 1998, the yield curve inverts. We have a significant correction. However, the market goes on to make new highs 4.3 months later, meaning if you did absolutely positively nothing during the correction in 1998 and held your positions, you had higher profits 4.3 months later, and then the market went on to make higher highs. Contrast that with this major peak here in March of 2000. Instead of taking 4.3 months to make your money back, the market didn't reach the same levels as this peak here for 91 months or 7.5 years later. This is the type of peak that falls into the serious volatility to respect category. The 2000 downturn lasted 21 times longer than this 1998 downturn. Hence, why we consider this to be a major peak, and this is a correction that was soon followed by higher highs in the market. And this inversion here is very, very similar to the present day. When the yield curve inverts in 1998, the last time it inverted was 8 years ago, which is very, very similar to the present day. The yield curve is falling, it's flattening, everybody's getting nervous. The present day, we haven't seen yield curve inversion for 10 years. So in this case, let's assume in the present day we invert and we act the same way in 1998. From a longer term perspective, that wasn't particularly helpful because the market didn't peak for an additional 668 days. And then prior to the major peak, we get a second bout of yield curve inversion that occurs 51 days before the stock market peaks. Let's compare and contrast the yield curve here that inverts 668 days before a major peak and then again 51 days before a major peak. Did we have any yield curve inversion looking backwards? The answer is absolutely positively no. So from a yield curve perspective, the peak in January of 2018 really looks nothing like the peak in March of 2000. How about the 2007 case? The stock market peaks on Tuesday, October 9th, 2007. Let's compare that to the present day peak from January of this year. In both cases, our charts go 151 days forward and 151 days forward. Why? That's where we are in the present day when these charts were made on Wednesday of this week. And thus, we can compare apples to apples again. 3-year period, 3-year period. In this case, we get a yield curve that's following and it inverts here. When the yield curve inverted, was it time to immediately run for the exits? The answer is absolutely positively no. From a longer term perspective, the stock market, after the yield curve actually inverted, didn't peak for an additional 651 days. Compare and contrast all of this inversion here before the peak, how long we have yield curve inversion, and it occurs for the first time 651 days prior to the major peak. In the present day, when we look back 651 days from the major peak, we have no inversion anywhere. Once again, from a yield curve perspective, the present day looks nothing like the major peak in 2007 from a yield curve perspective. And that's not an opinion. That's based on the facts that we have on our screen right now. Another point we should make, in our 151-day window where we're comparing apples to apples, we have already entered a recession in this shaded area here. Shaded areas indicate U.S. recessions. Well, unless GDP forecasts are way, way off, in the present day, we're not really anywhere near a recession. And remember, there's a big, big difference in the present day between the yield curve is about to invert and the yield curve has already inverted. Because extrapolating can be very, very dangerous. On the order of 225% dangerous. All right, let's think about something else. From a market perspective, when the yield curve inverts here in 1998, look how long the yield curve is flat. So during this entire period here, you could have been screaming, the yield curve is flat, the yield curve is flat, the yield curve is flat, the sky is falling. So what happened in this 668-day period? And I might add, this is a lot worse than the present day. This is actual inversion. We don't even have that in the present day. What did the stock market do from this point A to the major peak, or in this 668-day period? And before we answer that question, it's important to note, at this point, the last inversion is 8 years prior. So this looks a lot like this. And this is where we come to, how can the yield curve be helpful? Well, in this case, the yield curve inverts, and the market does experience a significant correction here. But as we noted earlier, it doesn't take very long to make all of your money back if you're in buy and hold mode. So the specific answer is, if I left the market on the day the yield curve inverted, I essentially would have been wrong for 668 days, and I would have missed the opportunity for a 39.62% gain. How about in the 2006 to 2007 case? What would have happened if we ran for the exits when the yield curve first inverted? Which is another way of asking what happened during this 651-day period before the major peak in 2007. This point A here is the same as this point A here. We did get somewhat of a pullback here. This is really shallow relative to what happened in 1998. So in this case, the yield curve from a shorter term perspective was helpful. However, if we shut it down right here and left the stock market completely, we basically would have been wrong for 651 days, and we would have missed an opportunity to participate in this gain, or at least some of a gain that approached 25% from point A to point B. So let's take a minute to talk about how the yield curve is helpful. The yield curve can be helpful. It's basically another box in the weight of the evidence checklist. Why would you want to include it? Because it has been helpful in the past from both a shorter-term perspective and a longer-term perspective. So when you get to this peak here, you know that the yield curve has been inverted for quite some time. And you can take that into account when you're looking at all of the evidence near this peak. But the other point to be made here is, what doesn't it tell us? So if we get yield curve inversion in the present day for the first time in a long time, it doesn't tell us that it's time to run for the exits. It doesn't tell us a bear market is imminent, and it doesn't even tell us that a recession is imminent. It basically tells us, looking out in a 2-year window, somewhere in that type of window, that we should check another box in our bearish weight of the evidence list. Here's another thing to keep in mind. On Wednesday, December 28th, 1994, the yield curve came about as close to inversion without inverting as it possibly could. It was at 0.09. Now we know, this is where I started at Morgan Stanley. I started in 1994. Everyone was freaking out about the yield curve here as well. You can make an argument that this point A here in 1994, the yield curve is about to invert. It's very, very similar to the present day, where we can say the yield curve is about to invert. What happened if we extrapolated and jumped the gun here and said it's inevitable that the yield curve is going to invert, and we sold everything? What happened in the stock market after this point here? So this point A and our inversion at 0.09 is the same as this point A. The answer is the S&P 500 gained 231% over several years, telling us a flattening yield curve, or a yield curve that's approaching the zero line, is not a full red alert for a bear market and a recession. And in fact, in this case, it really wasn't particularly helpful in any way. The market had steady gains, very low volatility after this point here, and we had a strong secular trend that lasted 1, 2, 3, 4, 5 years. Therefore, is it possible that after a point when the yield curve approaches zero, that really good things can happen? Of course it's possible. We have factual evidence supporting that claim, and it's right here on this chart. How about the NASDAQ? If I jumped the gun and extrapolated what happened from this point A here at the end, December 28th, 1994, so we're looking at late 1994 here, what happened next to the NASDAQ? The answer is, from a 0.09 level, we didn't have an imminent recession, we didn't have an imminent bear market, we didn't even have an imminent correction, just the opposite. We had a very, very strong trend that lasted several years, and the NASDAQ tacked on an additional 580%. And this point A here, just to be clear, is the same as this point A here, which is very, very similar to the setup in the present day, which simply tells us to keep an open mind about all outcomes, including the yield curve rallying before it inverts and preparing for possible inversion. A basic premise of the CCM market model is the fact that the miracle of compounding can work for us, and in the markets, typically, that's where we are. More often than not, the miracle of compounding works in our favor. However, after major peaks that are followed by major bear markets, the miracle of compounding can work against us. That's why The major peaks are what we're concerned about from a volatility to respect perspective. So let's assume in the present day that the yield curve inverted on Wednesday, June 26, 2018. And let's assume the worst, that inversion was going to lead to a major peak in the stock market that was similar to the process prior to the peak in 2000 and prior to the peak in 2007. The first yield curve inversion came 668 calendar days before the major stock market peak that was made on March 24th, 2000. That's the peak in the S&P 500. After the first sign of inversion, prior to the peak, the S&P 500 gained an additional 39.62%. Case number 2. The yield curve inversion came 651 calendar days before the stock market peak on October 9, 2007. After the first sign of inversion, prior to the peak, the S&P 500 gained an additional 24.56%. Therefore, in the present day, if yield curve inversion occurred on June 26, 2018, hypothetically, and we were going to follow a similar path to this peak here and this peak here, we know that the average number of days before the major stock market peak was 660 days after the first sign of inversion. The average gain between the first sign of inversion and the major stock market peak was 32.09%. Therefore, hypothetically, if the yield curve inverted on June 26, 2018, and using this level, the S&P 500 would peak, hypothetically, on April 16, 2020, at a level of 3566, which just reinforces the concept that even if the yield curve inverts, it does not mean we immediately go to full red alert. We simply check another bearish box on the weight of the evidence checklist. Before we shift gears to some risk-on, risk-off ratios and additional sets of economic data, stock outflows hit 3-month high amid growing trade tensions, published June 27, 2018. International stock funds see biggest weekly outflows since November of 2016. Does it make sense to run for the exits when everyone else is running for the exits? Did it make sense to run for the exits when everyone else ran for the exits at the end of November 2016? In this case, the answer was no. International stock funds from point A, the end of November 2016, to point B gained 26.78%. From Urban Carmel, 6:14 p.m., June 28, 2018. $20 billion flowed out of equity mutual fund and ETFs the past week. The only bigger outflow this year was the first week of February, which coincided with the year-to-date low in the S&P 500. If you ran for the exits like everyone else in the first week of February, was it particularly helpful? In the case of a risk-on asset like the FDN or Internet ETF, this is where everyone ran for the exits. This is what happened next. From point A to point B, the recent high, it gained 26.63%. We have similar outflows occurring in the present day. Like anything else, doesn't predict the future, it just speaks to odds of a potential rebound. As always, stick with me. We'll walk through this piece by piece. Initial jobless claims, or initial claims for unemployment insurance. So in this case, when the line rises, that's an indication of economic weakness with more and more people filing for unemployment. This is where the S&P 500 peaked in the spring of 2003. This is the stock market peak. Same data points in the present day, and this is where the S&P 500 peaked in late January of 2018. And once again, we'll compare apples to apples. This shows us the data points 151 days after the peak in the stock market. This shows us the same data 151 days after the stock market peak. In this case, in the 151-day window, we break a downward sloping trend line and eventually go on to make a higher high above this high, and these data points here. Contrast that, present day, same 151-day window after the peak, we recently made a lower low. This is the type of turn that we would be more concerned about. We really don't have anything like that now. We have a series of lower lows and lower highs. New home sales, similar situation, the major peak in 2000. S&P 500 peaks here. Housing peaked 631 days before the stock market. In the present day, S&P 500 peaks here. Our last peak in housing data, new home sales, was only 208 days ago. Compare and contrast that to 631 days before this peak. Here, in our 151-day window, we're nowhere near the previous high here. Not the case in the present day. We're knocking on the door of this 10-year high. This looks more like a downtrend. This low's lower than this low. This is another lower low. Here, we have a higher low relative to this low, a higher high, and a series of higher lows. Present day data looks better than it did before and after the peak in the year 2000. If you want to review a very detailed analysis of economic indicators, you can Google this title here and find this June 1st post on the fat pitch. It's a very, very logical and thorough presentation. Let's shift gears to the concept of the economic barge. In the year 2000 example, before a major peak, we said there were numerous reasons to be concerned relative to the facts in hand on the yield curve chart. Also, observable evidence on the chart of initial jobless claims. Relative to this, this is a lower low. Relative to this, this is a lower low. Similar situation with new home sales. New home sales peaked well before the stock market. We could see this, measure it, and put it into our weight of the evidence checklist. And all of these concepts tie into the charts that we cover every week in these videos. The reason why this stocks relative to long-term treasuries chart, and this is the S&P 500 mutual fund relative to a long-term treasury fund, so this is SPY relative to TLT in the ETF world. The reason why this is so jittery looking here and why this rolls over in this manner is market participants on the left side of the chart, some of them are seeing the deterioration in the data points. And some of them have already taken action over here. Others are very, very prepared to take action. This is our barge turning over time. Net aggregate opinion is bullish. Here's our turn. Net aggregate opinion is bearish. This chart reflects all of that economic data that we just looked at and basically anything else that you can think of. Valuations, the fact that a lot of dot-com stocks didn't have earnings, etc. If you can think of it, the market has thought of it as well. Similar situation in 2007. Notice how the stock bond chart, the market peaks here. Before the month of October is even over, we have a flattish, indecisive look here. That's telling us that many, many market participants were already concerned and ready to take action, or already had taken action before this rollover. And why this is important: major turns where you get major bear markets that can last several months or even several years, typically you can see it. You can see that barge turning over time. We can see this. We can see this. Let's compare these 151 days after this peak, S&P 500 peak, 151 days after this peak, does it look like the economic barge is even vulnerable here? The answer is no. We're supposed to compare this look to this look and this look. So if it was true in the present day that the flattening yield curve was indicative of the vast majority of market participants being concerned about a recession, we would expect to see some of that in our barge charts. Meaning, the present day shouldn't look like this. If the net aggregate opinion of all market participants said a recession was right around the corner, why would the conviction to own growth-oriented stocks be greatly exceeding the conviction to own defensive-oriented bonds? And that's from a long-term perspective, which is what we care about, the primary trend. This is screaming imminent recession potentially. It's one data point. This is screaming the potential, increased potential for a recession. We can't make that statement here. And remember, we have to compare this point to this point and this point, because all three of them are 151 days after the peak. And during this 151-day period, market participants have had plenty of time to review all of the evidence, including the yield curve, including concerns about a trade war, anything you can think of. And these are the facts that we have in hand today. Similar situation. If the yield curve was accurate and correct and a recession was right around the corner, we would expect market participants, so let's say you're running a mutual fund and your mandate is that you have to be 100% invested in stocks all the time. Intuitively, if you knew Armageddon was coming, you would migrate to more defensive stocks, consumer staples, XLP in the ETF world relative to SPY. And that's exactly what happened here. Look how quickly after the peak here, we get a flattening look and we start to roll over. The stock market peaks here. Within about a month, we have that very, very concerning look, telling us that the economic barge had already started to turn before the peak. And that's why it turned so quickly. How does the exact same chart look today? If a recession was right around the corner, we should expect to see something like this. We don't have anything like that in the present day. We're comparing this point here to this point here. This is a full-bore bearish look. After we could see this, measure it, and put it in a model, really bad things happened into the spring of 2009. This looks like strong and sustainable bearish conviction. This looks like strong and sustainable bullish conviction. Is it possible that this morphs into something like this? Yes, it's possible, but it hasn't happened yet. And we make decisions based on the weight of the evidence, the facts. Many ETFs weren't around in 2007 and 2000, so it's difficult to make the comparisons in some cases. But here's another, it's hard to see a recession right around the corner chart. This is high yield, riskier bonds. If I'm getting a higher yield than a treasury, so this is junk bonds, JNK, relative to intermediate term treasuries, 7 to 10 year treasuries. Let's think in extremes. If you knew a major financial crisis and devastating recession was right around the corner, would you want to own higher risk bonds that have a higher risk of default relative to intermediate term treasuries that are backed by the full faith and credit of the U.S. government? Well, the answer is simple. You would want to own IEF over JNK. We would expect to see some deterioration here. We just don't have that right now as of June 27, 2018. And as always, we'll continue to take it day by day. Remember, we said before the peak, there are some market participants that are seeing the writing on the wall in the economic data, valuations, leverage, you name it. Some of them, early adopters, are seeing it before people that run for the exits after the peak. So here, 90 days after the stock market peaked in the year 2000, just 90 days, we have a full-bore bearish look on our stock versus long-term treasuries chart. Again, SPY relative to TLT in the ETF world. This tells us there was a lot to be concerned about back here. 90 days after the peak, both of these are one-month charts. We're comparing apples to apples. The barge looks like it's still headed on a bullish course. We don't even have moving averages starting to roll over. April 26, 2018, 90 days after the peak, 90 days after the peak. This look here does not align with the theory that the average market participant believes a recession is right around the corner. This look does. This is a concerning look. How about the 2007 case? How vulnerable was the barge to making a turn? 49 days after the peak, which occurred in October of 2007, this is a 2-month chart. Here we have a full-bore bearish look. Look how quickly the barge turns. The stock market peaks about right here, literally within days. Blue rolls over, red rolls over, eventually green rolls over, a rollover. And in a little more than a month, we have that tight cluster. We don't like this look. And after this, after we could see it, measure it, and put it in a model, really bad things happened. How does the same chart look 49 days after the peak in the present day, looking back 2 months? The answer is quite a bit better. March 16, 2018 is 49 days after the S&P 500 peaked in late January of this year. This, from a bullish conviction perspective, is not screaming imminent recession, is saying we better be careful. From a weight of the evidence perspective, from our buddy Ryan, here's his Twitter handle. The New York Stock Exchange advanced decline line remains firmly in the bull camp here. It has turned lower ahead of all bear markets since 1950. In summary, is the yield curve helpful and is it worth monitoring? We believe the answer is yes. We believe the yield curve is helpful. But it's one piece of useful evidence. And while the vast majority of articles written about the yield curve take a bearish perspective, not all of them. There are some really, really good articles and pieces of research out there on the yield curve that are very, very balanced. Most of them won't tell you that the yield curve can be an eyelash above inversion, and then after this, and this look is very, very similar to the present day, 2018, after this, when people were saying the yield curve is about to invert, really, really good things happened. And even better things happened in the NASDAQ. Which means, like anything else, relative to the yield curve, we have to keep a flexible, unbiased, and open mind about all outcomes. And if the yield curve actually inverts in the present day, that would increase our concerns about two things. Number one, the odds of a correction or a pullback taking place sometime in the next 1 to 6 months. And it would increase the odds of a recession and bear market occurring sometime down the road. And sometime can be as long as 668 calendar days. If we compare the present day to extreme cases, we can learn a lot about risk versus reward. Corrections and pullbacks are a fact of life in the stock market. There is a ton of gut-wrenching volatility between point A and point B, and yet the NASDAQ tacked on 580%. If we take a weight of the evidence approach and head into next week and every week with a flexible, unbiased, and open mind, it can help us assess the probability of good things happening relative to the probability of bad things happening. And that includes the probability of very bad things happening, like on the order of a 50% decline, on the order of a 50% decline. Right now, the weight of the evidence tells us that the present day pullback or any future pullbacks look more like a correction within the context of an existing and ongoing uptrend. And if that's the case, if we are in a correction, and that's what the weight of the evidence says, eventually the market will go on to make higher highs, just as it did after this gut-wrenching correction in 1998. It's inevitable at some point in the future, whether it's in a week, a month, a year, 10 years, 30 years, eventually the weight of the evidence will start to tell us that we have to respect the possibility of the next pullback being a serious bear market rather than a correction that goes on to make higher highs. And the yield curve is helpful in terms of assessing the weight of the evidence. We just have to know how to use it, what it tells us, and what it doesn't tell us. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.